Somewhere on Earth, roughly every 10 seconds, a Da Vinci surgical robot begins a new operation. The machine in the room costs about $2 million, and here is the strange part. The machine is not the product. In the last video, we asked whether a cheaper robot could break into surgery. Today, we walk into the building everyone is attacking. Intuitive Surgical, 25 years of monopoly, 85% recurring revenue, more than 20 million recorded procedures, and a stock that has fallen 40% while earnings kept beating. This is a 1-hour deep dive into the anatomy of a monopoly. Let's take it apart. Here is the plan for this hour in 10 acts. First, what this company actually is, because robot maker is the wrong answer. Second, where it came from. A military research project, a patent war, and 2 near-death experiences. Third, the machine itself, how a single surgery becomes revenue dollar by dollar. Fourth, the platforms. Da Vinci 5, the single port system, Ion, and the data layer growing on top of all of them. Fifth, the numbers. Fresh through the July 2026 earnings report, which is 11 days old as I record this. Then the moat, honestly assessed, including the parts that are weaker than the fans admit. The contest, Medtronic, Johnson & Johnson, China, and the Surgery Center flank from our last video. The bear case, properly steelmanned. The price and what a 41% drawdown actually changed. And finally, a verdict with 6 things worth watching. One housekeeping note before we start. This is research, not investment advice. Now, Act 1. Act 1, the toll booth. Intuitive Surgical, in one screen. Founded 1995 in Sunnyvale, California. Public since June 2000. Its flagship, the Da Vinci system, does robot-assisted, minimally invasive soft tissue surgery. The surgeon sits at a console a few feet from the patient, and the robot translates their hand movements into tiny wristed instruments working inside the body through small incisions. Today, there are 11,710 Da Vinci systems installed around the world, and they performed 3.15 million procedures in 2025. That is an average of nearly 300 procedures per system per year, and the number per system keeps rising. Add Ion, a second platform that navigates lung biopsies with over 1,000 systems of its own. Revenue last year, $10.07 billion, up more than 20%. Net income, $2.9 billion. Debt, 0. Market value today, roughly $128 billion. Do the division on those procedures and you get the line that opens this video. Somewhere on Earth, a Da Vinci case starts about every 10 seconds. Now look at where the money actually comes from, because this is the single most important slide for understanding the company. 3 businesses. Instruments and accessories, $6 billion, almost 60% of revenue. Systems, the actual robots, $2.5 billion, under a quarter. And service contracts, $1.6 billion. Here is the mechanism. Every single Da Vinci procedure consumes proprietary instruments. Not most procedures. Everyone. A 100% attach rate. The robot is the razor. The instruments are the blades. And when you add up instruments, accessories, service, and lease payments, roughly 85% of this company's revenue recurs automatically, case after case, whether or not a single new robot is sold that quarter. Most investors still file Intuitive under capital equipment, next to companies that live and die by hospital purchasing cycles. That filing is 20 years out of date. Systems revenue is the construction business. The tolls are the company. So the correct mental model is not a device maker. It is a toll road, 3 dials. Dial 1, capacity. 11,700 systems is the road network, and it grows about 12% a year. Dial 2, traffic. 3.15 million cases a year, growing in the mid-teens and growing faster than the system count, which means each mile of road carries more cars every year. Dial 3, the toll. Roughly $1,900 of consumables per case on average, set by Intuitive and drifting upward as procedures get more complex. Multiply the 3 dials and you get the annuity. Every strategic question in this video, every competitor, every risk, every piece of the bear case is an attack on one of these 3 dials. Keep them in mind. Capacity, traffic, toll. We will come back to them in the final act, because the entire investment debate reduces to which dials hold. The compounding record with only verified numbers on the table. Revenue, $8.35 billion in 2024, $10.07 billion in 2025, up 20.5%. The second quarter of 2026 alone, $2.89 billion, up 19%. Procedures, 2.68 million, then 3.15 million, up 18%. The installed base compounds about 12% a year, and the cumulative counter has now passed 20 million procedures since the year 2000. 20 million operations, recorded, on one company's platform. Here is the framing that makes it land. This company raised $46 million in its initial public offering in June 2000. 25 years later, it produces a $10 billion revenue year, and its yearly net income is over 60 times everything it raised going public. One strategy the whole way. Place the road, grow the traffic, own the toll. Very few companies on any exchange have compounded a single business model this cleanly for this long. So here is the thesis of this hour, stated up front so you can argue with it as we go. Intuitive is a metered consumable annuity wearing a robot costume. 25 years of regulatory moat, training moat, and now a data moat, wrapped around 85% recurring revenue. In 2026, it faces its first genuinely contested year. 2 new competitors cleared by the FDA within 8 months, China scaling domestic clones, and growth decelerating from 18% toward 14%. And the market has already delivered its verdict. The stock sits roughly 41% below its high, while earnings keep beating estimates. That combination, business intact, price cut nearly in half, is rare enough that it deserves a full hour of attention. The business question for the next hour: does the data flywheel compound faster than the contest erodes the toll? Everything else follows from that. Act 2, Origin, from DARPA to standard of care. Surgical robotics was born twice in 2 different labs for 2 different missions. Lineage 1, the telepresence dream. In the late 1980s, SRI International, the Stanford spin-off research institute, built a system called Green Telepresence. The National Institutes of Health funded it first. Then DARPA got interested because the military wanted something radical: operate on wounded soldiers from a distance, surgeon in the rear, robot at the front line, no medevac delay. And on that SRI research team was a young engineer named Gary Guthart. Remember that name because he will run the company for 15 years. Lineage 2, Space Robotics. A company called Computer Motion built a robot arm called ISRG under a NASA research contract, originally imagined for servicing spacecraft. In 1994, ISRG became the first surgical robot ever cleared by the FDA, a voice-controlled camera holder. It evolved into Zeus, a full surgical system that assisted the first robotic heart bypass in 1998. 2 bloodlines, military and space. They will collide in court, and one will absorb the other. 1995. A surgeon entrepreneur named Fred Mall sees the SRI telepresence system and understands what it could become. His employer, Guidant, passes on it. Too futuristic. It is one of the great missed acquisitions in medical device history. So Mall leaves, teams up with venture capitalist John Freund and engineer Robert Young, licenses the SRI technology, and incorporates Intuitive Surgical in December of 1995, backed by Mayfield, Sierra Ventures, and Morgan Stanley. In March 1996, a young engineer named Dave Rosa joins as employee number 9. Hold that thought, because employee number 9 runs the company today. By 1997, they have a working prototype, and they nickname it Lenny, as in young Leonardo, because the production system already has its name reserved: Da Vinci. A company built on rejected intellectual property, named after the man who drew flying machines 500 years before anyone could build them. The year 2000 and one remarkable summer. In June, Intuitive goes public on NASDAQ and raises about $46 million. A loss-making startup selling $1 million robot that most hospitals had never seen, going public into the last months of the dot-com bubble. 1 month later, in July, the FDA clears the Da Vinci system for general laparoscopic surgery, the first telemanipulation platform cleared for soft tissue surgery in the United States, licensed to operate and publicly funded in the space of a few weeks. Everything that follows, everything in this video, is one continuous compounding run on that base. 46 million raised then, 10 billion in annual revenue now. But first, the young company had to survive 2 existential tests, a patent war with the older rival, and a market that was not yet convinced anyone needed a surgical robot at all. The patent war. Computer Motion, the older company with the NASA lineage, sued Intuitive right before its initial public offering, and by the year 2000 there were 8 lawsuits in play between the two companies. 2 platforms head-to-head, Zeus at $975,000, Da Vinci at roughly $1 million. For 3 years the litigation dragged on both companies' growth, burning cash on lawyers that should have gone to placements, and creating exactly the uncertainty that makes hospital purchasing committees wait. Then, March 7, 2003, merger. Intuitive absorbed Computer Motion, took its patent estate, its ESOP installed base and its engineers and quietly phased out Zeus. Think about what that means. The monopoly was not only built through better engineering. Part of it was bought in 2003 for stock. From that day until December 2025, no other multi-port soft tissue surgical robot was cleared in the United States. 22 years of open road. That is the monopoly this video is dissecting. Every platform needs a wedge, and for Da Vinci it was the radical prostatectomy. Removing a cancerous prostate means operating deep in the pelvis, around delicate nerves that control continence and sexual function. Open surgery is brutal there. Laparoscopy is possible but punishing, long instruments working at awkward angles. The robot's wristed instruments and 3-dimensional vision fit that anatomy almost perfectly, and urologists became the first true believers. Then something unusual happened. Patients started asking for the robot by name. Men researching prostate surgery found Da Vinci and chose hospitals accordingly. Hospitals bought Da Vincis to avoid losing patients to the hospital across town, which is the strongest sales force ever invented. Fear of losing the customer. Urology built the installed base, and every later specialty, gynecology, general surgery, thoracic, inherited a robot that was already down the hall, already paid for, already staffed. File the pattern away. One procedure where the robot is clearly better funds a platform that spreads sideways. Today's challengers are copying exactly this playbook. That is why Act 7 takes them seriously. Now the first crisis chapter, because the clean origin story is not the honest one. 2013. Some instrument tip covers could crack during surgery, letting electrical current arc into surrounding tissue. Patients were injured, some severely, and the FDA found that Intuitive had underreported adverse events, hundreds of them, filed late or not at all. In July 2013, a formal FDA warning letter landed, citing the reporting failures and quality system gaps. Shareholder lawsuits followed, aimed at the reporting failures and at insider stock sales near the top. The stock fell roughly 31% from its February high that year, wiping out years of gains in months. Here is the part that matters for us today. It was a compliance failure, not a product failure. The company rebuilt its reporting and quality systems under regulatory supervision. And through the entire storm, procedure volumes kept growing quarter after quarter. The stock broke. The annuity did not. Keep that sentence. We will need it again in Act 9. Crisis Chapter 2 came a year later. In 2014, the power morcellation scare hit gynecology. Concerns that a tissue removal technique could spread undetected cancers made national headlines, and hysterectomy volumes wobbled across the whole industry, robotic or not. And before both of these, in the 2008 financial crisis, hospitals had simply frozen capital budgets, and robot purchases stalled for over a year while the stock was cut in half. 3 different wounds, a compliance crisis, a clinical scare, a capital freeze. The market read each one as structural as the end of the story. Each turned out to be cyclical. Each time procedure growth resumed, the consumable annuity recompounded, and the stock eventually followed the procedures, because the procedures are the business. That is the recovery pattern this company has printed 3 times in 25 years. Whether 2026 is the 4th repetition, or the time it really is different, is precisely the question the rest of this video works on. And there is one honest answer available already. This time, for the first time, there are cleared competitors on the field. Hold both thoughts. 5 platform generations tell the hardware story. The original Da Vinci in 2000, the S in 2006, the SI in 2009, the XI in 2014, still the workhorse of the fleet, the single-port SP in 2018, and Da Vinci 5 in 2024. Each generation reset the clock for anyone trying to catch up, because each generation re-cleared the instruments, the software, the whole stack. The leadership story has just one handoff in 15 years. Gary Guthart, the engineer from the original ISRG team, ran the company from 2010 to 2025. On July 1, 2025, he handed the keys to Dave Rosa, employee number 9, 29 years inside the building. The man who founded the Clinical Engineering Group and the Endoluminal Group, which means the single-port system and ion are literally his product lines. Guthart stays as executive chair. Jamie Samath has run finance since 2022. The succession is from within, engineer to engineer, and it lands at the exact moment real competition finally arrives. A new chief executive's first contested year, worth watching closely. Act 3, The Machine, How a Surgery Becomes Revenue. Let's get concrete. What does one surgery actually pay intuitive? Depending on the procedure's complexity and the instruments used, between $700 and $3,600 of instruments and accessories per case. A routine gallbladder sits near the bottom of that range. A complex colorectal resection with advanced stapling and energy instruments sits near the top. Divide last year's $6 billion of instrument revenue by 3.15 million procedures, and the fleet average is about $1,900 per case. The attach rate is 100%, because without instruments there is no case. And those instruments carry gross margins above 70%, which makes the instrument division alone one of the most profitable franchises in medical technology. The mix is drifting upward too, toward advanced energy and stapling instruments, so the toll rises with acuity. Multiply $1,900 by 3 million cases, and you understand the business. The blades alone out-earn most medical device companies in their entirety. The robot is the loss leader. The case is the product. Why doesn't someone just clone the blades? 2 locks stacked on top of each other. The technical lock, every endo-wrist instrument carries a programmed life. A usage counter counts down with each procedure, and when it hits 0, the system will not run that instrument again. A foreign or expired instrument simply does not work. Hospitals have tried reprocessing services. The counter defeats them. The regulatory lock is the deeper one. Those instruments are cleared by the FDA as part of the integrated system. Their materials, their software handshake, their counters. A third party selling cheaper compatible blades must run the full regulatory gauntlet against a platform that keeps moving underneath them. New generation, new instruments, new clearances, clock reset. It is printer ink economics, except the regulator validates the cartridge. That is why 25 years of aftermarket pressure, hospital procurement squeezes, and reprocessing companies never commoditized this consumable stream. The toll is defended by the FDA's own process. Now the move almost nobody talks about, and it is one of the most revealing things this company has ever done. In the 4th quarter of 2020, mid-pandemic, Intuitive re-rated its high-volume X and XI instruments from 10 uses to 12 to 18 uses. Same instrument, same price, more procedures per purchase. Management said it plainly at the time. This reduces our revenue per procedure. They cut their own toll on purpose by up to 1/3 on the affected instruments. 2 readings, both true. Goodwill. Hospitals were bleeding cash in the pandemic, and cutting their cost per case when they hurt buys loyalty that outlasts any sales campaign. Defense. A lower toll per case leaves less oxygen for every cheaper robot pitching its economics against yours. And in 2020, the cheaper challengers were already raising money on exactly that pitch. And a further extended use round is reportedly planned for 2027. Only a monopolist can cut its own price on schedule. Only a confident one actually does it. Remember this slide when the bear case arrives, because this same move shows up there with the sign flipped. The quiet third business, service. $1.57 billion a year, roughly $140,000 per system per year on average, contracted, predictable, renewing with the fleet, and staffed by the only field engineers who are allowed to touch these machines. Now added up per machine, because the picture inverts. A Da Vinci lists for between $1.4 and $2.6 million depending on configuration. Real money. But over a typical decade of life, that machine generates thousands of procedures worth of instruments and 10 years of service contracts. The machine sale becomes the smallest number in its own story. One placement seeds 10 years of annuity, which raises an obvious strategic question. If the sale price is the smallest number in the relationship, why insist on collecting it up front at all? Why not remove the one barrier, the capital committee, that slows down placements? And that is exactly where Intuitive has been heading. Increasingly, it does not sell the road, it rents it. Look at the second quarter of 2026. 468 systems placed. Only 214 were bought outright. 254, 54% went out as operating leases, up from 49% a year earlier. And 131 of those, 28% of all placements, were usage-based. The hospital pays per procedure, like a true toll road. No capital committee, no bond issue, no barrier. And if the robot sits idle, the hospital pays little. Intuitive is voluntarily taking utilization risk onto its own book, because it knows its utilization numbers better than anyone. That confidence opens surgery centers, community hospitals, and price-sensitive international markets that could never write a $2 million check. Management also noted about half of U.S. placements were trade-ins, hospitals upgrading to Da Vinci 5, with their old XI systems refurbished into the XIR fleet and resold or leased down market. Yesterday's razor, resold with a fresh service contract. The accounting effect. Reported system revenue looks softer today and the annuity gets deeper tomorrow. Optics down, moat up. When you see bears citing soft system revenue, check the lease line first. Assemble the machine. Step 1, place the system. Sold, leased, or paid per use, whatever the customer can absorb. Step 2, every case consumes $700 to $3,600 of validated instruments forever. Step 3, every system carries a service contract, another $140,000 a year. Step 4, the newest. Every case generates data, and Act 4 is about what that data is becoming. Added up, and roughly 85% of revenue arrives on schedule whether or not a single new robot is sold that quarter. That is the machine. It was designed this way from the very beginning, annuity first, hardware second, which is why the founding team hired razor blade veterans and not just roboticists. Now let's look at what the hardware has become, because the current generation is not really a robot upgrade. It is a computer that happens to hold scalpels, and that distinction is where the next decade of this company will be decided. Act 4, the platforms. Da Vinci 5, the flagship, cleared in March 2024, broad U.S. launch by mid-2025. The headline feature is force feedback, a first in mainstream soft tissue robotics. The surgeon actually feels tissue resistance through the console controls. In preclinical work, surgeons using it exerted up to 43% less force on tissue, and early clinical observations point the same direction. Under the hood, roughly 10,000 times the computing power of the XI. Hold that number, because it is not there for the surgery of today. The market's answer: 246 Da Vinci 5s placed in the second quarter of 2026 alone, up 37% year over year, including 114 dual console configurations. The teaching setup. New software features now arrive by clearance and update. 3 force feedback features cleared in September 2025 alone. The installed base is around 1,700 systems in about 2 years. More than 12,800 surgeons have operated on it. And by late 2025, 85% of U.S. placements were choosing the new platform. This is the refresh wall. Once a hospital upgrades its training, its workflows, and its data all live on Da Vinci 5, and the trade-in feeds the refurbished fleet downstream. But here is the real story of Da Vinci 5. It is a data engine that happens to operate. 4 streams captured from every case. The surgical video itself, the instrument kinematics, every movement of every wrist millimeter by millimeter, the force signals from those new sensors, and the workflow context around the procedure. A product called Case Insights turns those recordings into structured performance analytics. How this surgeon's cases compare to the field, where time is lost, which techniques correlate with better outcomes. This is the kind of telemetry that software companies take for granted and medicine has never had at scale. And the commercial signal that should make you sit up, the subscription layer on Da Vinci 5, called My Intuitive Plus, went through its first renewal wave with 0 customer opt-outs. 0. Nobody who started paying for the data layer decided it was not worth it. Hardware, instruments, service, leases, and now a 5th stream forming. Software subscriptions on data the fleet generates anyway, at software margins. Competitors can build an arm. They cannot buy 20 million recorded procedures, and they cannot buy the second 20 million either. January 26, 2026, the cardiac door opens. The FDA cleared Da Vinci 5 for 9 thoracoscopically assisted cardiac procedures: mitral valve repair and replacement, tricuspid repair, closing septal defects and patent foramen ovale, left atrial appendage occlusion, removing atrial myxomas, internal mammary artery takedown for bypass work, placing pacing leads. For scale, over 2 million open-heart surgeries happen worldwide every year, and in 23 years, only about 140,000 robotic cardiac procedures have ever been done on Da Vinci. In other words, cardiac is the one great cavity robotics never conquered, a market larger than everything robotics has captured so far, sitting right there. The play is exactly the prostatectomy play from 2001. Pick the procedures where the robot's precision genuinely fits. Mitral repair is delicate, reconstructive, deep in a tight space. Build the evidence, train the specialty, and let cardiac surgeons pull the platform in. A brand new frontier, opened in the same year the competitors finally arrived at the old one. That timing is not a coincidence. It is a message. While you are entering my market, I am opening the next one. The single port system, SP. 3 wristed instruments and a fully articulating camera, all through one single incision about the size of a bottle cap. Through 2025, it was a specialist tool, urology, head and neck surgery, with roughly 300 systems installed. Then December 2025, the FDA cleared SP for inguinal hernia repair, gallbladder removal, and appendectomy. Read that list again. Those are the highest volume general surgeries in existence. Millions of cases a year, and they are exactly the wedge procedures every ambulatory challenger needs to survive. The procedures the cheaper robots were designed to win. SP procedures were already growing 91% year over year, with more than 500 peer-reviewed publications behind the platform, and approvals in Europe, Japan, and Korea. The strategic read is simple. Aim the single-port system straight at the beachhead the challengers are trying to land on, with a cosmetically superior single incision as the patient-facing pitch. Deny the wedge before it widens. We will see in Act 7 whether it is working. ION, the second toll road. Lung cancer screening programs keep finding suspicious nodules deep in the lung, too deep for conventional bronchoscopes to reach reliably. ION navigates a thin robotic catheter out to them and takes the biopsy. 1,096 systems installed, 55 more placed last quarter, and procedures up 36% year over year, the fastest growing line in the company. Same razor blade economics. catheters and probes consumed per case, every case. Inside it sits a moat within the moat, shape sensing fiber, the optical technology that lets the catheter know its own position in three-dimensional space without radiation. Intuitive bought that intellectual property outright in 2021, taking it off the table for everyone else. Johnson & Johnson's Monarch system competes here already, so this market is contested and always has been. But Ion proves something strategically vital. The annuity playbook transfers beyond Da Vinci. Place the platform, meter the consumable, build the evidence, compound. It worked twice. That is not a product. That is a repeatable machine for building products. In July 2026, at the Robotic Surgery Society meeting, Intuitive laid out its AI strategy as a 5-layer stack, and it is worth walking slowly. Layer 1. Good data, standardized capture at fleet scale, which Da Vinci 5 now does by default. Layer 2. Meaningful insights, the case insights analytics already selling. Layer 3. Intraoperative guidance, real-time support during the case, the near frontier. Layer 4. Augmented dexterity, AI-assisted precision under surgeon command. And Layer 5. The long-term destination, supervised autonomy, where the system performs defined subtasks. Think suturing a standard closure, and the surgeon supervises and stays accountable. The foundation underneath is the 20 million plus recorded procedures, a dataset that crossed 20 million in late 2025 and grows by 3 million a year. The company also says its in-house vision language models, trained on surgical video, outperform general-purpose AI on surgical reasoning tasks. You should treat every company's AI claims with standard skepticism, including these. But the structural fact stands regardless. Nobody else has the data to even attempt this ladder, and the gap widens every 10 seconds, one recorded case at a time. And in July 2026, the 1989 dream finally went live. A surgeon in one state operating a Da Vinci 5 in another, California and Georgia, in a live telesurgery demonstration. This is the original DARPA telepresence mission, 4 decades later, at commercial readiness. Intuitive brands it connected care and keeps the regulatory posture deliberately conservative. Expertise expansion, remote proctoring, rare case support, rather than science fiction promises. China's Microport runs remote demonstrations too, at distance records, so this is a race, not a solo. Why it belongs in the moat story. Telesurgery multiplies the value of the biggest network. A specialist beamed into a community hospital, an expert proctoring a difficult case 3 time zones away. All of it only works on the platform that is already installed everywhere, already credentialed, already connected. The bigger the road network, the more valuable every new lane. Now, from the dream to the spreadsheet. The numbers act, and it is 11 days old. Act 5. The numbers through July 2026. The second quarter print July 16th. Revenue, $2.89 billion, up 19%, beating estimates of $2.82. Adjusted earnings per share, $2.80 against expectations of about $2.51, a 12% beat and up from around $2 a year earlier. Adjusted gross margin, 70%, or 68.7%, excluding a one-time tariff refund of $28 million that flattered the quarter by 8 cents a share. Operating margin, 33.6% on standard accounting. Net income, $818 million for the quarter. Procedures up 16% worldwide, Da Vinci up 15%, Ion up 36%. 468 systems placed against 395 a year ago, with Da Vinci 5 and the leasing engine doing the work. By any operational standard, an excellent quarter, and another beat in a streak of beats that goes back years. Hold that thought while you look at what happened next, because the market's reaction is the most instructive slide in this act. The market's answer, minus 11.6%. The stock closed at $402 before the print and traded down to about $356 after hours, a $50 billion company's worth of value gone in an evening on a beat. 6 days later, Johnson & Johnson's Ottava cleared the FDA, and the week of July 20th printed a low of $328. So what actually disappointed? Not the quarter. Guidance. Intuitive held its full-year procedure growth outlook at 13.5 to 15.5%. Held. After raising it at the first quarter, the market had priced another raise, and merely confirming became a letdown. Remember the baseline, 2025 grew 18%. The deceleration from 18 toward 14.5 is now guided, official, on the record, no longer a bare speculation. At a premium multiple in line is a downgrade. Nothing in the quarter broke. What broke was the assumption that the guide only ever goes up. That assumption was carrying about 30 multiple points, and Act 9 shows you exactly where they went. Step back from the single quarter and look at the trajectory, because single quarters lie and trajectories mostly don't. Revenue, $8.35 billion in 24, $10.07 in 25, and 2 quarters near 19% growth each this year. Net income, $2.3 billion, then $2.9 billion, and over $800 million per quarter this year. Procedures, 17% growth, then 18, now easing toward the guided 13.5 to 15.5. Notice the gap between revenue growth and procedure growth. Revenue grows several points faster. That gap is mix. More Da Vinci 5 systems in the field, more advanced instruments consumed per case, the toll drifting upward with acuity exactly as designed. So yes, deceleration is real from 18 toward 14. But deterioration is not. Margins improved through it, mix improved through it, and the per-case economics strengthened through it. Slower traffic growth on a road that charges more per car is a very different disease from an emptying road. The balance sheet, next, is why the company can afford to treat the difference calmly. The balance sheet quickly, because there is mercifully little to say, and that is the highest praise a balance sheet can earn. Debt, 0. 25 years as a public company, never levered through 3 crises and 2 platform transitions. Cash and investments, about $8.6 billion. Shareholders' equity, over $18 billion. Operating margin, 33.6%. Operating cash flow last year, $3 billion, converting earnings to cash at nearly 1-to-1. Research and development, 13% of revenue, over $1.3 billion a year, funding the autonomy roadmap, the cardiac expansion, and the next platform generation simultaneously. This is the boring slide, and boring is the point. No refinancing risk, no covenant, no interest rate exposure can force a bad decision at a bad moment. When your business model is a 20-year annuity, the balance sheet's only job is to never interrupt the compounding. This one cannot. And when the stock derates anyway, a fortress balance sheet becomes an offensive weapon. Next slide. Capital allocation tells you what management believes better than any conference call, so read it. In fiscal 2025, Intuitive repurchased $7.95 billion of its own stock, the largest buyback year in company history, retiring shares at scale for the first time rather than just offsetting stock compensation. In April 2026, the board expanded the authorization to $5 billion, and another $380 million was repurchased in the second quarter. There has never been a dividend, and management's stated priority order is reinvest first, repurchase second. Research and development is guided to grow faster than sales and administrative costs, which is the spending signature of a company that believes its moat is technical. Put the pieces together. The heaviest repurchasing in company history landed exactly as the stock derated. Management is buying the drawdown it is being punished with. That is either conviction from the people with the most information, or a warning about discipline from the people with the most bias. Act 9 gives you the framework to decide which. One structural move abroad closed in March 2026. Intuitive bought its own Southern European distributor, the AB Medica Group and its affiliates. Italy, Spain, and Portugal, plus Malta and San Marino, are now direct markets, adding about 250 employees and more than 470 installed systems under direct company control, with Ion freshly launched in Italy and Spain on top. The logic is annuity logic. Distributor margins become Intuitive margins, Service quality comes in-house, and every European case now feeds the same data and subscription machine as an American one. Not everything abroad is smooth, and the honest ledger says so. Japan's procedure growth is running below its historical trend, weighed down by fewer system placements in 2025, and Europe's hospital capital environment stays uneven. Tender by tender, the emerging pattern: own the last mile where the annuity is rich, partner where policy demands it. Which brings us to the one market where policy is the whole game: China. It gets its own slide in the Contest Act because it has earned it. First, the moat honestly assessed. Act 6, the moat honestly assessed. Moat Layer 1, the consumable annuity you now know cold. 85% recurring, 100% attach, price per case, proven across 4 drawdowns. Layer 2 is the human one, and it is bigger than it looks. The installed base plus training lock-in. 11,700 systems and a surgeon pipeline that trains on Da Vinci by default, in residency, before ever holding an attending job. Getting credentialed is a defined pathway. Online modules on the company's learning platform, simulator proficiency scores, wet lab work, proctored cases with an experienced surgeon watching, then hospital privileges, specialty by specialty. Multiply that by every surgeon in a department, and switching vendors means retraining a hospital, recredentialing a staff, and rebuilding operating room workflows. For zero clinical payoff, the hospital can promise its board. An entire generation of surgeons has never operated robotically on anything else. That is not brand loyalty. It is muscle memory, credentialed, insured, and refreshed with every case. A competitor does not just need a better robot. It needs to be worth relearning surgery for. Moat Layer 3 is the one almost nobody discusses, and it may be the most load-bearing of all. The regulator guards the cartridge. The consumable instruments are cleared as part of the system. Their materials, their usage counters, their software versions, the whole integrated stack. One filing. A third party wanting to sell compatible blades must clear the full regulatory process against a platform that keeps moving. New generation, new instruments, new clearances. Clock reset again and again. The economics of that chase are brutal. Spend years clearing a clone of an instrument that gets superseded before you ship. This is why, in 25 years, no gray market consumable economy ever formed at scale around Da Vinci, something you cannot say about almost any other high-margin consumable in healthcare. Hardware can be copied, prices can be undercut, but the toll itself, the per-case consumable stream, is defended by the FDA's own process. So when you hear that some new robot is 30% cheaper, ask the only question that matters to this business model. Who validates their blades, at what scale, and how fast can they iterate? That question kills most challenger pitches on contact. Layer 4 is the newest, and it is the reason this company now talks like a technology firm. The data flywheel. Walk the loop. More systems produce more cases. More cases produce more data. 20 million procedures and counting, now recorded in 4 synchronized streams by Da Vinci 5. More data produces better software, performance analytics today, intraoperative guidance tomorrow, supervised autonomy on the roadmap. Better software makes the platform stickier, and the subscription renewals with zero opt-out say the stickiness is real. Stickier platforms win more placements, and around the loop it goes, faster each turn. Layers 1 through 3 defend today's toll. Layer 4 is the bet that tomorrow's toll is priced in intelligence rather than steel. That in 10 years, hospitals pay intuitive not mainly for instruments, but for the accumulated surgical judgment of 20, by then 40 million cases, delivered as software nobody else can train. That is the bull case in its purest form, and unlike most AI stories in 2026, this one owns its data source outright. Now the honest slide, because the moat has one weak wall, and pretending otherwise would make this video worthless. Here is what the clinical evidence actually says without marketing. Where robots measurably win: complex anatomy. In rectal cancer, recent meta-analyses of randomized trials show significantly fewer conversions to open surgery, better oncological margins, and more lymph nodes harvested, real, patient-relevant differences in the hardest cases. Add surgeon ergonomics, careers extended by not hunching over an operating table for 30 years, and broader access, more patients getting minimally invasive surgery at all because more surgeons can deliver it robotically than laparoscopically. Where the evidence is flat, many routine procedures show roughly equivalent outcomes to standard laparoscopy, with operating times around 20 minutes longer and consistently higher cost per case. Payers have never paid a premium for the robot, and they still do not. The facility absorbs the robotic cost within a standard procedure payment, so the moat is not clinical superiority everywhere. It is workflow, training, evidence in the hard cases, and surgeon preference. State it that plainly and the bear case loses its favorite ambush, because you have already conceded what is true and kept everything that is actually defensible. The annuity never needed the robot to be better at gallbladders. It needed surgeons to prefer operating on it. They do. Act 7, the contest. Map the battlefield by which moat layer each challenger attacks, because they are not all attacking the same wall. Medtronic's Hugo attacks the hospital multiport core with bundling power, cleared in the U.S. since December 2025 for urology. Johnson & Johnson's Ottava attacks the operating room footprint with table integration, cleared July 22, 2026, 7 days before this recording. Distalmotion's Dexter attacks cost in surgery centers, cleared for hernia and gallbladder work, the subject of our previous video. Moon Surgical's Maestro attacks workflow as a robotic assistant rather than a full platform. And China's Microport Taomai attacks with price and policy at home, exporting outward from a protected base. 8 months, December to July. The U.S. market went from monopoly to 3 cleared multiport platforms. That is the fastest structural change in this industry's history, and it is the single best argument that this time is different. So let's take them one at a time, seriously, no strawman. Medtronic Hugo, the credible second. Cleared December 3, 2025 for prostatectomy, nephrectomy, and cystectomy on the strength of the Expand URO trial. 137 patients, 98.5% surgical success against a goal of 85, complication rates well under their thresholds. That is a real clinical result, not a technicality, and Hugo is now operating commercially at flagship American centers. In June 2026, Medtronic announced submissions for general surgery and gynecology indications, with a robotic version of its Pro Grip hernia mesh already cleared, and its Liga Sure Energy instruments moving onto the platform. And here is the actual weapon, not the robot. Medtronic sells instruments, staplers, energy devices, and sutures into every operating room in America. It can bundle Hugo into supply contracts hospitals already sign and discount the robot against the portfolio. The realistic read: Hugo wins share in price-sensitive accounts, internationally first, and hands every American hospital a negotiating lever against Intuitive, which compresses pricing quietly even where nobody switches. What it does not have: the consumable lock, the training base, or 25 years of evidence. Those take a decade to build. Medtronic has the patience and the balance sheet to spend that decade. That is what a real second looks like. Johnson & Johnson's Ottava cleared 7 days before this recording. July 22, 2026, the FDA granted de novo clearance for 10 upper abdominal procedures on the 4-day trial, 30 patients, 6 hospitals, 0 conversions, first human cases in April 2025. The design is genuinely different. 4 robotic arms that fold into the operating table itself, freeing floor space in cramped rooms and promising simpler setup between cases. It was unveiled back in 2020, delayed 2 years, and now begins a selective U.S. launch. Keep the scale honest on both sides. Ottava starts with 10 procedures against Vinci's 70-plus indications, tens of systems against 11,700, 0 accumulated procedures against 20 million. But Johnson & Johnson brings surgical instruments, Ethicon staplers and sutures, a global sales machine, and note the hedge. Its venture arm also funds DistalMotion, the surgery center challenger. Big pharma-scale money is now committed to this category from two directions at once: strategically serious, long-horizon, deep pockets, but a clearance is a starting line, not a finish line. Ask Hugo, which cleared 8 months earlier, and is still counting placements in the dozens. So why doesn't a better arm topple the annuity? Walk the stack a challenger must build to actually take the toll, not just place robots. First, its own validated consumable stream, cleared, manufactured at scale, and attached to every case, because that is where the money is. A robot without a consumable annuity is a showroom piece that loses money. Second, a retrained surgeon base and recredentialed hospitals against muscle memory built in residency. That is thousands of surgeons, one proctored case at a time. Third, an evidence mountain built trial by trial against 25 years and hundreds of publications per Da Vinci platform line. Each layer alone is a decade. A challenger needs all three at once, while Intuitive cuts its toll with extended use instruments, rents the road through usage leases, and opens cardiac, exactly the flexibility a monopolist with 70% instrument margins can afford and a subscale entrant cannot. The rational outcome for most challengers is a niche or a price lever for hospitals, not a regime change, unless the game board itself is different. And there is exactly one place on the map where the game board is different: China. China is Intuitive's second largest procedure market. About 1 million Chinese patients have been treated on Da Vinci through a joint venture with FOH Sun Pharma that goes back nearly a decade, and over 80% of the XI systems installed in China are now manufactured locally through that venture, in Shanghai. That localization is the hedge, and it exists because the rules in China are genuinely different from everywhere else. Hospital allocation quotas gate every large equipment placement. A hospital needs a provincial permit before it can even buy. Volume-based procurement squeezes prices in centralized tenders. And policy can, and does, prefer the domestic champion. Microports Taomai and other local platforms are scaling with state support, lower price points, and a mandate to substitute imports. Intuitive is running a multi-year outcome study with Peking University precisely to defend its value story to Chinese officials with Chinese data. And the climate hardens in both directions. In July 2026, U.S. regulators moved to restrict some Chinese-made robots on supply chain grounds. In every other market, the moat's rules favor the incumbent. In China, the rules themselves are negotiable. Local manufacturing is the right hedge. Whether it is a sufficient one is a genuinely open question, and it is the one geography where I would not extrapolate the past. And the flank where our last video ended, surgery centers. The verdict then: ambulatory robotics is an investable wedge, not yet a mass market, and the incumbent can likely absorb it. 1 quarter later, the absorption strategy is fully visible. Trade-ins from Da Vinci 5 upgrades feed the refurbished XIR fleet, priced for surgery centers. Usage-based leases, 131 in the second quarter alone, remove the capital barrier entirely, and the single-port clearances for hernia, gallbladder, and appendix aim directly at the wedge procedures. Meanwhile, Dexter operates in its first American surgery centers through the Surgery Partners chain, and Moon sells its assistant model into laparoscopic rooms. Both still owe the market one number, proven all-in cost per case at chain scale. Until that number exists publicly, the wedge is a thesis, not a market. Watch one metric on Intuitive's side: instrument revenue per procedure as surgery center mix grows. If the flank forces the toll down faster than volume grows, the wedge is working and the bear case strengthens. So far, the toll is rising, not falling. The flank exists. The bleeding does not yet. Act 8, the bear case steelmanned. Bear argument 1, deceleration. Procedure growth was 18% in 2025. The guide says 13.5 to 15.5, and at the July print that guide was held, not raised, breaking a pattern of raises the market had learned to expect. Japan is below trend. Europe is uneven, tender by tender. None of that is catastrophic, but compounding math is merciless. A premium multiple is a promise about the second derivative, and when growth steps down a gear, the multiple re-rates before the business changes at all, which is exactly what you watched happen in Act 5. Bear argument 2. For the first time in this company's public life, the competition is real and cleared. Hugo in December, Ottava in July, China's clones at home, and a surgery center insurgency being funded by Johnson & Johnson's own venture arm. Even hospitals that never switch gain a negotiating lever, and levers compress pricing quietly, contract by contract, renewal by renewal, without a single headline announcing it. Slower and surrounded. That is the bear's opening statement. It gets sharper from here. Bear argument 3 is the subtle one, and it is the best one. The toll itself gets cheaper, by Intuitive's own hand. The extended use program cut revenue per case in 2020, and a further round is reportedly coming in 2027. The leasing shift, 54% of placements now, trades headline revenue today for annuity tomorrow, and usage-based deals put utilization risk on Intuitive's book. The surgery center and refurbished fleet push deliberately seats procedures in lower toll settings, because defending share there means accepting thinner economics there. Each of these is a management choice. Each is strategically sound in isolation, and each dilutes revenue per case while it defends share. The bear's sharpest formulation goes like this. The moat survives, nobody displaces Intuitive, every challenger stays niche, and the stock still underperforms for years, because a slower growing annuity with a gently declining toll deserves neither the old growth rate nor the old multiple. Notice what makes this version dangerous. It requires no competitor to win. It only requires arithmetic. The rebuttal that mix and acuity have outrun every toll cut so far is in the numbers, but it has to keep being true. Bear arguments 4 and 5, macro and medicine. Tariffs are guided to cost roughly 1% of revenue this year, real money at a 10 billion revenue scale, and management flags rising freight and memory component costs into the second half, the price of building computers that do surgery. Hospital capital spending remains financing sensitive, and history says robot purchases pause when money gets tight. 28 was the proof. On the medical side, GLP-1 drugs are shrinking bariatric surgery. Volumes are down about 21% from their 2023 peak, while prescriptions run past 1 million a year. Bariatrics is a small slice of Intuitive's procedure mix, but the mechanism deserves respect. A drug just displaced a surgery at population scale, and that is a genuinely new kind of risk for the entire surgical category. And the honest evidence slide from Act 6 caps the pricing argument. Where outcomes are equivalent, you cannot charge forever for elegance. 5 bear arguments. Individually manageable. The bear case is that they all bite in the same 2-year window, and that is roughly what the last 12 months of price action has been pricing in. Which brings us to the pre-mortem. Every serious thesis needs a pre-mortem, so here is the kill condition, stated precisely enough to be falsified. The thesis breaks if instrument revenue per procedure declines, while procedure growth also sinks below roughly 10%. The annuity compressing from both ends at once, fewer new cases, and less toll per case. That is the combination no buyback and no balance sheet can offset, because it means the machine from Act 3 is running in reverse. The plausible paths there ranked. A surgery center challenger proves chain-level economics and forces toll cuts far beyond plan. China policy displaces the joint venture faster than local manufacturing can defend it. Or payers change how robotic surgery is reimbursed, the lowest probability and the highest impact. None of those is visible in today's data. The toll is rising. China still allocates quota to Da Vinci, and payer policy is inert. All of them are worth standing watch on. A good bear case is a checklist, not a mood. That was the checklist. Now let's price all of it. Act 9, the price of perfection. The anatomy of a 41% drawdown date by date. The all-time high, $616, January 2025. A retest to $604 in January 2026, So this is not an old wound, it is this year's. Then the slide. The 400s through spring, routine insider sales printing in the 440s in May, 402 on the day before the July print, then minus 11.6% after hours on held guidance. 6 days later, Ottava clears, and the week of July 20th prints the capitulation low, $328.57. Today, about 362, peak to trough minus 47%, peak to today minus 41. And here is the fact to hold against that chart. Over the same 18 months, revenue grew about 19%. Procedures grew mid-teens and earnings beat every single quarter. The business and the stock told two different stories, which means this is a multiple event, not an earnings event. The fourth such drawdown in the company's history. The first with cleared competitors on the field. Both halves of that sentence matter. So what does $362 actually price? Market value, about $128 billion. Annualize the first half's adjusted earnings and you get roughly $4 billion a year. Call it 32 to 33 times earnings. At the January 2025 peak, the same arithmetic ran at 60 to 70 times. The derating cut the multiple nearly in half while the earnings grew underneath it. Read it plainly, without cheerleading in either direction. At 70 times, the market was paying for perfection, a monopoly without end, a guide that only ever rises, no competitor ever clearing. At 33 times, the market pays for a very good, decelerating compounder with real competition on the field, which is, notice, exactly what the company now is. Perfection is no longer in the price. Mid-teens compounding still is, which means the risk has migrated. Less valuation risk than at any point in years, more execution risk than ever before. That is not a buy signal or a sell signal. It is a precise description of the trade on offer, and the scenarios make it concrete. 3 roads from here, and notice they differ on exactly the 3 dials from Act 1. The bull road. Procedure growth reaccelerates past 15% as cardiac, general surgery, and international mature. The toll holds or rises with mix. The rivals stay niche while the data layer starts monetizing visibly, subscriptions and software clearances, and the multiple recovers toward its premium history. The base road. 13 to 15% procedures, a roughly flat toll as extended use offsets mix, competitors functioning as price levers rather than share takers, and the stock compounds with earnings at around today's multiple. The business does the work, not the re-rating. Mid-teens earnings growth at a held multiple is a perfectly respectable outcome, which is the quiet point of the base case. The bear road. Growth sinks below 10, the toll declines for years, China share loss becomes visible in the disclosures, and the multiple compresses again toward ordinary medtech. Capacity, traffic, toll. Watch the dials, not the drama. Everything else, every headline, every clearance announcement, is commentary on one of those 3 numbers. Act 10, Verdict. The verdict in plain language. You are no longer paying the perfection premium. At roughly 33 times earnings, you get the toll booth on 3 million surgeries a year. Debt-free. 85% recurring. A 20 million procedure data head start, with the cardiac frontier just opened and a subscription layer renewing at 100%, entering the first genuinely contested stretch of its 25-year life. The business question is whether moat layer 4, the data flywheel, compounds faster than the contest erodes the toll. The evidence so far says yes. The toll is rising, the renewals are perfect, the dataset is uncatchable. The stock question is simpler and harder. Is 14% procedure growth a floor or a stair-step down? Nobody knows that today, including management, which is why the guide was held. And the 2013 lesson cuts both ways. The annuity has survived every drawdown so far, but every drawdown so far happened without a single cleared competitor on the field. This one has 2, and China behind them. That is what makes this moment, for the first time in 2 decades, genuinely interesting. 6 things worth watching, each mapped to a dial so this video stays useful after today. 1. Procedure growth against the 13.5 to 15.5 guide. The second half prints decide the floor or stairs question. 2. Instrument revenue per procedure, the toll, as surgery center and extended use mix grows, the single most information-dense number the company reports. 3. Hugo's general surgery and gynecology decisions, which open or fail to open the second front beyond urology. 4. Ottava's launch cadence systems cites first published procedure data. 5. China allocation quotas, tender pricing, and Taomai's share of new placements. 6. Data layer monetization, subscription attach rates, and new software clearances. 4 and 5 are capacity. 1 and 3 are traffic. 2 and 6 are the toll. If the dials hold, the annuity does the rest, at whatever multiple the market's mood assigns. If 2 of them turn together, reread Act 8 before the market does it for you. A word on method, because you should know how this was built. This deep dive runs on CorticalFlow's research engine, primary securities filings, the financial statements, event filings and insider filings in machine-readable form, clinical literature, a purpose-built surgical robotics corpus, and a knowledge graph over companies and capital flows. Every material claim was verified against multiple independent sources before publication. Figures are as of July 29, 2026, with quarterly data through the July 16th report. And the disclaimer that matters: this is research opinion, not investment advice. Nothing here is a recommendation to buy or sell any security. Companies change, prices change faster, do your own work. If this hour was useful, the previous video asked whether a cheaper robot can break into surgery, and the two are designed as a pair, the attackers and the incumbent. Thanks for watching. This was CorticalFlow Research.